Every payday, a piece of your money disappears before it ever reaches your account, and most people can't tell you exactly where it went. Your pay stub has the answer, line by line, but almost nobody reads it. If you're a blue-collar worker grinding out a week on a job site, a warehouse floor, or a hospital ward, you've stared at that pay stub, clocked the gap between what you earned and what you kept, and felt that quiet suspicion that somebody, somewhere, is getting over on you. Everybody's got a version of the first paycheck story. You worked the hours, you ran the rough math in your head on the drive home, and then the check landed a few hundred short of the number you were counting on. Nobody explained it. The money was just gone. So let's read the thing line by line and follow where it all goes. By the end, none of it is a mystery. Quick disclaimer first. I'm not a tax professional, an accountant, or a financial advisor. Nothing here is tax advice, and I'm not going to tell you what to claim or how to file. This is plain English on what those numbers mean. For your own situation, talk to a real professional. Start with the two numbers that matter most, and they're usually the first thing you see. Gross pay is the big one up top, everything you earned before anybody took a cut. Net pay is the one at the bottom, what shows up in your account. The whole story of a pay stub is how the big number becomes a smaller one. And for most working people in this country, take-home lands somewhere between 70 and 82 cents on every dollar earned. The rest leaves before you ever see it. Let's put real numbers on it. Say you make $60,000 a year, solid blue-collar money, right about what the average electrician pulls. You'd figure 60 grand means 60 grand. It doesn't. First out is FICA, which is two separate taxes wearing one name. Social Security, which shows up on your actual stub as OASDI, takes 6.2% of your pay. On $60,000, that's $3,720 a year gone. Medicare takes another 1.45%, about $870. That's FICA. It isn't optional, it isn't negotiable, and it shows up on nearly every paycheck you'll ever earn. So what does that buy you? This is the piece the stub never spells out. Social Security isn't the government pocketing your cash. It funds retirement checks, disability, and survivor benefits, the money that goes to a worker's family if he dies on the wrong end of a bad day. Medicare covers hospital care once you hit retirement age. You're paying into the system that's supposed to catch you on the far side. Whether it's still standing when your turn comes is a whole other conversation. But that's where the 6.2 and the 1.45 are headed. It's worth knowing Social Security only taxes you up to a limit, $184,500 in 2026. Earn past that and the Social Security piece shuts off for the year. Medicare never shuts off. For most of us, that cap may as well be on the moon, but now you know it's there. Next line, federal income tax, and this is the one people get wrong constantly. You've heard somebody swear they turned down overtime or a raise because it would bump them into a higher bracket and leave them with less. It's one of the most stubborn money myths going, and it's flat wrong. Nobody ever loses money by earning more. Let me show you why, slow and simple. Picture a row of buckets lined up on the floor. Your paycheck pours in from the left and fills the first bucket all the way before a single dollar spills into the next one. That first bucket is the cheap one. The government takes just 10 cents out of every dollar sitting in it. Once it's full, the money spills into the second bucket, and that one runs a little steeper, 12 cents on the dollar. Keep earning, and the money keeps spilling down the row into pricier buckets, all the way up to a top bucket that costs 37 cents on the dollar. And the myth gets the next part exactly backwards. The price of a bucket only ever touches the money sitting inside that bucket. When your dollars spill into a more expensive one, They don't reach back and retax everything in the cheap buckets behind them. The dollars in the 10-cent bucket stay 10-cent dollars for good. So a raise can't cost you money. The higher rate only ever lands on the new dollars stacked on top, never the ones already settled underneath. There are 7 of these buckets in all, from 10% at the bottom to 37% at the top, and hardly anybody fills the expensive ones. On a $60,000 paycheck, your money never spills anywhere close to the high buckets. After the standard deduction lifts the first $16,100 clean off the top, your federal income tax for the whole year lands around $5,000. A long way from what that bracket number makes you brace for. Here's a term worth keeping. Your marginal tax rate is the rate on your top bucket, the highest one your money reaches. Your effective tax rate is the average across all of them combined. On 60 grand, your marginal rate might be 22%, but your effective rate, the real number, lands well below that. Knowing the difference is how you stop panicking at a bracket number that never actually applies to your whole check. That standard deduction is money the government agrees not to tax at all, a freebie skimmed off the top before the buckets even start filling. In 2026, it's $16,100 for a single person, double that for a married couple. The IRS sets the number, and it inches up most years. Then there's state income tax, and that one's down to your zip code. 9 states don't charge it at all. Alaska, Florida, Nevada, New Hampshire, South Dakota, Tennessee, Texas, Washington, and Wyoming. Live in one of those and your stub skips the line. Live anywhere else and the state takes its cut too, anywhere from about 3% up past 13%, depending where you are. Before you start packing for Texas, the no-income tax states tend to claw it back through property and sales taxes. Nobody runs a state for free. Total it up on that 60 grand. Social Security, $3,720. Medicare, about $870. Federal income tax, around $5,000. In a no-income tax state, that's roughly $9,600 gone, and you take home a little over $50,000. Spread it across a check every 2 weeks, you gross about $2,300, and a little under $2,000 lands in the bank, usually by direct deposit. The rest was spoken for before you woke up on payday. That's only the taxes. Your stub probably has a whole other section, deductions, and they split into 2 kinds that matter more than people think. Pre-tax deductions come out before the tax man runs his math, your 401k, your health insurance premium, and HSA. Because they go first, they shrink the income you get taxed on. Drop $1,000 into a traditional 401k, and depending on your bracket, that same move shaves something like $220 off your tax bill. Post-tax deductions are the reverse. They come out after the taxes are settled, so they lower your check without lowering your taxes. A Roth contribution, certain insurance, and wage garnishments like child support all sit down here. Now, the overtime question, because for a lot of you, this is the big one, and it's where that bucket myth does the most damage. You've heard it on every job site in America. Don't pick up that extra shift. They'll tax it so hard it isn't worth it. Guys turn down real money over this, so let's settle it. First, what overtime even is. Federal law says once you work past 40 hours in a week, your boss owes you time and a half, 1.5 times your normal rate for every hour past that line. That's the law, not a favor. Now the myth. When a big overtime check hits, it does look like the government backed a truck up to your account and took half. More gets withheld than usual, and it feels like a penalty for working harder. But what's going on is simpler than it looks. Overtime is not taxed at some special higher rate. There is no overtime tax. Those extra hours are ordinary income, and they drop into the same buckets from before. 10 cents, then 12, and on up. What you're seeing on that check is withholding, not your final tax, and that's a real difference. Withholding is just your employer's guess at what you'll owe, paid early. When a fat overtime check runs through, the payroll software often panics and assumes you pull that much every single week of the year. So it holds back like you leapt into a high bracket. You didn't. At tax time, the real math gets done and the government hands the extra back. You'll see it all reconciled on your W-2 in January, the form that tallies everything your employer reported for the year. They sat on your money for a few months, interest-free, and called it withholding. Annoying. But it was never actually gone. And if they held too much, that's your tax refund. So, the straight answer. Does working more overtime ever leave you with less? No, it can't. Thanks to those buckets, an extra shift only gets taxed on the new dollars stacked on top, never the ones underneath. You will always pocket more by working the hours than by skipping them. The guy turning down overtime to dodge taxes is leaving real money on the table over a story that was never true. Two honest catches, though. The first isn't about taxes at all. A handful of income-based programs, certain health care subsidies, some housing help, phase out as you earn more. So a monster year of overtime can in rare cases push you past a cutoff and cost you a benefit. Worth knowing if you're sitting close to one of those lines, but it's a different animal than your tax bracket. The other one is the catch nobody prints on a pay stub. Your body and your time. No overtime rate buys back the sleep, the shot knees, or the kid's game you missed. The money is real. So is the bill your body mails you eventually. It's pay me now or pay me later. One last piece, and it's new. Under a recent federal law, there's a temporary deduction on overtime running from 2025 through 2028. It lets workers write off the extra half of that time and a half, the premium part above your regular rate, up to $12,500 a year for a single person and twice that for a married couple. It starts shrinking once you earn past $150,000. In plain English, you only get to write off the extra paid to you on top of your normal wage. So if your regular hourly rate is $25 per hour, even if you're salaried, it's broken down this way for overtime calculations. Then you would earn that plus 50% on overtime. This would make your overtime rate $37.50. The only money you can write off on the new tax bill is that extra $12.50. Your regular rate, even in excess of 40 hours worked, does not qualify. Two more limits to know. It only touches federal income tax, so Social Security and Medicare, those OSDI and Medicare lines on your stub still come out of your overtime exactly like always. And whether your state goes along with it is its own question. It's a genuine break for people who live on extra hours, but it's the kind of thing where you check with a tax pro about your own situation instead of trusting a stranger on the internet. There's one number on the stub almost nobody reads, and it's the most useful one on the page. YTD year to date. A running tally of everything since January 1st. Every dollar earned, every dollar taxed, every dollar withheld. Folks ignore it until tax season, and that's a mistake. Every so often, somebody online tells the same story. They finally added one check times the number of checks they'd been paid, held it against the YTD number, and the math didn't line up. Turns out the company had been shorting them for months. They only caught it because they read the one line everybody skips. That's real money, hundreds of dollars, sitting in plain sight. And come January, those YTD totals are exactly what feeds into your W-2. So if the numbers ever look off, catch it before the form gets mailed. One last thing the stub won't brag about. For every dollar of Social Security and Medicare taken out of your check, your employer quietly paid the same amount on top, matching you to the penny. You never see it and you never touch it, but it's money spent in your name. The true cost of putting you to work runs higher than your salary, and the real tax on your labor is bigger than the slice on the page. So here's where it lands. The gap between gross and net isn't a riddle, and it isn't a scam. It's FICA paying into the retirement and medical system. It's federal and state income tax. And it's whatever you set aside for later or for your benefits. Some of it you can't touch. Some of it, like the pre-tax money, is a lever in your own hand. The people who get ahead aren't the ones earning some secret number nobody else knows. They're the ones who read the page and quit guessing. You don't need to be an accountant to understand your own paycheck. You just need somebody to walk you through it once. Next payday, pull up that stub and read it like you own it, because you earned every dollar on there, even the ones that left before you could wave goodbye.